Well, hey everyone. Welcome to the talk. I'm your host, Lisa K. Crawford, and I'm so glad to be here in this space with you to talk about a very important topic in real estate. Many of you know I am a licensed real estate broker associate with United Realty Group here in South Florida. um, I enjoy working in real estate, and I want to talk some about getting ready for the purchase. So, if you are in the market to buy, then you're a purchaser. And there are some things that you need to know as a purchaser in this market. One of the things you need to understand is that it's a very competitive real estate market out here, extremely competitive, which means that when you decide to put an offer in on a property, you want to make sure that your contract, your offer, is going to get the seller's attention. And in order to get the seller's attention, there's going to be some things that are going to have to be attractive to that seller. So let's talk about what could get your contract noticed over someone else's. What could get your contract to the top of the pile, so to speak, so that that seller wants to deal with you as a buyer over any other potential buyer, over any other potential contract that is being considered. So, one of the ways you can get yourself to the top of the pile is to get your financing in order. Make sure you're ready to go. If you're a cash buyer, then you're ready to go. All you need to do when you put in an offer on a property is to submit proof of funds with your offer. And that will get a seller's attention in a huge way. So you submit proof of funds. If your purchase price is 500,000, then you submit some type of bank document or statement that shows that you have the funds to cover the entire purchase price in the bank. Yes. So not only do you want to show that you can say purchase the property for the $500,000 that it's being sold at, but you also have to have a little extra money in the bank because you're going to have to be able to come up with closing costs as well. So that may be another 4 to 5% of your purchase price will can be considered your closing costs. So leave some extra funds available for the closing and closing costs. So that's what you do if you're on the cash side. Now, what if you're not a cash purchaser? If you're not a cash purchaser, then you're financing. That means that there is a lender involved. There's a mortgage lender, there's a commercial bank, there is a hard money lender. There is someone that's lending you money for the purchase. And in that situation, you have to think competitively too, because once again, you want a seller to notice your contract before anybody else's. So there's two things you can do with regard to loan financing. You can go to a bank even before you find a property, and you can get pre-qualified to purchase a property with that bank. So when you get pre-qualified, and remember this term because I'm going to distinguish it from pre-approved. So you're getting pre-qualified when you go to the bank. You're giving them some information about your finances, some indication about how much money you make on an annual basis. You're giving them some indication about how much your debts are, how much you hold in debts, so that they can give you a pretty good ballpark of how much money they're likely to lend you once you go through the formal lending process. So that's what pre-qualified is. Now, we are going to look at pre-approval as an alternative to being pre-qualified by a bank. When you're pre-approved, that implies that you have been looked at a lot more closely by that financial institution. They've taken a good look at your finances. They most likely have looked at several years' tax returns. They may have looked at your W 2s as well as some of your wage statements. And they, meaning the lending institution, is putting together a much more serious type of offer in terms of what they will lend to you. Now, generally, you're never going to get 100% from a bank. So, in some cases, if you can get 95% of what you're trying to borrow, that's great. Years ago, it used to be that the most you could get is like 80%. But there are some better loan products out there where you could get up to 95% of your purchase price through a loan, which means that you're only coming to the closing with 5% of the total purchase price, and that 95% is being financed. So if you're getting pre-approved, they're looking more closely. It probably represents a pull on your credit. So it will have some effect on your credit because it's more of a formal process of looking at your ability to be able to borrow money. So when a bank comes back to you and they give you that pre-approval letter, that is pretty much the bank's weight uh, in gold right there, because they're telling you, lender or buyer, we will lend you 365,000, or we'll lend you 450,000. And as they say, you can take that to the bank. So then when you get that pre-approval letter, when you put an offer in on that property and say your pre-approval is 500,000 and the property you're looking at is 450,000. So you want to put in your contract and you want to take that pre-approval letter from the bank and you want to put that right on top of the paperwork so that the seller knows that you've already been pre-approved, you've already been through some formalized underwriting process through the financial institution, and you are otherwise ready to go with that loan. So, those are some things to remember: how to be competitive, whether you are a cash buyer or whether you're financing your loan. You want to make sure that you're competitive and that the seller pays attention to your offer over anybody else's. So, pre-approval is better than being pre-qualified. If you have a choice to be pre-approved by a bank or a mortgage lender versus being pre-qualified, get pre-approved. And remember that that is a pull on credit. And what do I mean by a pull on credit? That usually when someone pulls your credit, it can actually affect or bring your credit score down slightly during that process of reviewing your credit. Under the opposite one, when we talked about pre qualified, that's what they call a soft pull. It really doesn't have an effect on your credit. But a hard pull where they formally go through and check and review credit will definitely bring your scores down a little bit. So you don't want to be out there getting credit and having your credit scores affected when you're also in the process of getting pre-approved for a mortgage loan, because all of those credit pulls definitely bring your credit scores down, and those things can definitely impact you when you go to get a loan. So, a low credit score can affect your interest rates. In other words, if the lower the credit score, probably the more interest you'll end up paying on that loan, because banks think that you're probably a greater risk than someone with a higher or better credit score. Banks think, oh, chances are we'll get our money back. So we'll work with them. We're not going to charge them as much because we think they're not as risky, as much of a risk on credit. So keep those things in mind. If you need help, I'm Lisa K. Crawford. I am a real estate broker associate with United Realty Group. I help people buy and sell real estate here in South Florida. And as a matter of fact, I can help you no matter where you are, all over the world. I can help you because I can connect you with awesome realtors who will help you with your real estate needs. So, again, I'm Lisa K. Crawford. If you have any questions about the pre-approval versus the pre-qualified process for mortgage loans, feel free to give me a call. At our brokerage, we have an in-house mortgage lender as well as an in-house title company. So we are indeed a one-stop shop when it comes to finding your next property. Again, I'm Lisa K. Crawford, signing out, 954-864-8950, if I could be of any assistance to you. Have a great day, guys. Talk to you again soon. Bye-bye.